Good afternoon and welcome to the Virginia Local Government Investment Webinar. This is the second of two presentations. My name is Greg Pagans and I'm a registered representative with broker-dealer Multi-Bank Securities Incorporated. Today, in Part 2, we will briefly review Part 1. With the given that a formal investment policy has been approved by pertinent constitutional or other local officials and is in place, and we'll provide a short discussion of public funds investing in high credit quality fixed income securities. And we'll also introduce the Public Funds Investors Guide, brought to you by the Multi-Bank Securities Institute. Slide 3 displays different pertinent Code of Virginia statutes, which include in Section 2.2, Chapters 4500, the Investment of Public Funds Act, Chapter 4501, Legal Investments for Other Public Funds, Chapter 4502, Commercial Paper, Chapter 4505 regarding Treasury certificates, Chapter 4514, a standard of care, Chapter 4518, the investments of funds and deposits. Additionally, we'll briefly cover Section 2.2, Chapters 4400, involving the Virginia Security for Public Deposits Act, and 4401, definitions for qualified public depositories and public deposits. I'm not going to read these statutes. Much of this information can be found in Part 1 for your reference and convenience. Section 2.2, Chapter 4514, Standard of Care, has several emphases regarding, quote, public funds. Quote, they shall be held in trust, and any investments shall be made, quote, solely in the interest of the citizens. And it refers to the prudent person rule. The prudent person rule constrains investments to three priorities: seeking reasonable income and preservation of capital, and not being for speculation. Through the years, market participants have created a straightforward acronym that's very easy for public funds investors to remember: SLY, safety, liquidity, and yield, in that order. Section 2.2, Chapter 4516 refers to the liability of treasurers or public depositors. When the statutes are followed, the Virginia Code indemnifies individuals from personal liability. Regarding the investment of public funds policies and priorities, back to the safety, liquidity, and yield. The safety is also referred to as credit risk. In this context, this addresses the likelihood that investors will get their promised interest payments along with the return of their principal at the maturity of the stated investment or contract. With the most creditworthy borrowers, or the highest quality of debt, obligors are considered to have what is referred to as a strong to a very strong to an extremely strong capacity to maintain their financial commitments. Regarding liquidity, for a security that's part of an investment policy or portfolio, is it easy to get bids in case the security needs to be sold? Do you have the availability of many independent and competitive quotes? Also regarding liquidity, are there narrow spreads between the bid and offered side prices? U.S. Treasuries, as an example, are often considered the most liquid market in the world, and many times spreads are less than 1/64th of a percentage point, or a little over $150 per million between the bid and asked prices. Regarding yield, the return on high credit quality investments is most likely going to be the lowest in market rates. Many fixed income products show various spreads over and higher yields than comparable maturity U.S. Treasuries. The highest credit quality items will trade closest or tightest to the U.S. Treasury curve. This next section of the Virginia Local Government Investment Webinar today includes information from the Public Funds Investor Guide, courtesy of the Multi-Bank Securities Institute. This is a no-cost resource we provide to our clients. Predicated upon an existing approved investment policy, there are many investment strategies that use high-quality fixed income securities. As part of the presentation today, we'll briefly describe active and passive investing. An active investing strategy has a goal of total return, which counts both interest and any capital appreciation or price gains on securities held. This is heavily focused on research, often in specific market sectors, and sometimes tries to predict market actions and is in competition amongst peers and other money managers. A joke someone made years ago is it's like picking up nickels in front of bulldozers. Trying to find opportunities or value in market mispriced bonds, keeping up with changes in credit parameters from different issuers, and then changing maturities and duration of portfolio depending upon the manager's or the investor's interest rate outlook. Most often, active strategies are used by pension fund and mutual fund managers who have a much longer time horizon regarding maturity and portfolio. With a passive investing strategy, the investor seeks to copy performance of a specific market or market sector or a chosen index or benchmark. There is no trying to time the market. There's no trading, including buying and selling of securities based on market movements. The investment vehicles and the credit quality are specifically determined in the stated investment policy. And importantly, to public funds investors, this minimizes the attempt to make predictions or maintain certain expectations. It also lessens the time spent managing the portfolio and any analysis. Buy and hold and laddering are passive strategies that have served public funds investors well. In a buy and hold investment strategy, securities are purchased with the intent to hold them to maturity. This strategy does not use capital appreciation for total return. Securities are simply held to maturity, and when they mature at face value or 100 cents per dollar. This helps public funds investors maintain an anticipated cash flow, takes away guesswork, and it helps to achieve market rates of return. Additionally, it helps to mitigate interest rate risk. In rising interest rate environments, maturities provide cash flow and opportunity to reinvest at higher interest rates. In falling interest rate environments, longer maturities within the ladder lock in yield. Regarding laddering an investment portfolio, this creates a portfolio of staggered maturities and then uses the proceeds from maturities to reinvest or take needed cash, and when reinvesting, put that money out to the longest maturity rung on the ladder. The great thing about ladders is they can be easily structured to meet anticipated cash flow needs, whether debt servicing, construction draws, or other special products. Securities used by many public funds investors, and among those mentioned in the Code of Virginia Investment of Public Funds Act, include U.S. Treasury bills, notes, and bonds. U.S. Treasury items are a direct obligation of the United States government. They are considered to be the highest credit quality, and as previously mentioned, U.S. Treasuries are often considered to be the most liquid items in the world. Agency bonds and discount notes, please note for our discussion today, we are not talking about mortgage-backed securities. This is simply agency bonds. Agency issues include Federal Home Loan Bank, Federal Home Loan Mortgage Corporation, also referred to as Freddie Mac, and Fannie Mae, the Federal National Mortgage Association. These securities, too, are considered to be the highest credit quality and have a very liquid secondary market in case investors might need to sell before maturity. For U.S. Treasury and agency bonds, these trade at different dollar prices. Discounted, 100 cents on the dollar, often referred to as par, or premium. For someone unfamiliar with markets, a discount can be thought of as buying a $1 bill for a price less than 100 cents, 98 or 99. Anything less than par is considered discount. Likewise, anytime a premium is paid more than 100 cents on the dollar, that's a premium. The simplest yield calculation can be stated by using the coupon and dividing it by the dollar price. To continue with our previous example, a 3% coupon, stated coupon bond bought at 100 cents on the dollar would have a simple yield of 3%. Were an investor to buy that 3% coupon for less than 100 cents on the dollar at a discount, the yield would be higher than 3%. And likewise, were an investor to pay more than 100 cents on the dollar or a premium for that 3% coupon, the yield would be less than 3%. Investors buy a stated face amount. For example, $1 million. They have to have a way to settle their trade in which it's exchanged money for the security. Usually these trades settle for cash or the same day of trade. They often settle trade day +1 or T+1 the next day. Sometimes new issue bonds have a forward settlement. These securities will have a specific QSIP, a description, and a stated final maturity. QSIP is the Committee for Uniform Securities Identification Procedures. Thinking colloquially, it can be known as the Social Security number for a specific bond or security. When investors buy agency securities, many times they participate in new issue markets where different agencies and underwriters offer new issue agency bonds. This group is referred to as the syndicate. And as long as the new issue security is in syndicate, it must be offered from any dealer at par, 100 cents on the dollar. A bullet maturity bond has no call options, simply a stated final maturity. A callable bond may be called by the issuer before maturity. Investors are paid on a called bond 100 cents or par dollars plus their accrued interest. There are different call structures issued by many different issuers. European call is a one-time only call option. A Bermuda call can be a structure that is more frequently callable. Oftentimes a Bermuda call is calendar quarterly. Lastly, an American call is a continuously callable bond, usually after a specific lockout period. Additionally, some bonds, as part of the contract when the bond is created, may have step coupons that if the bond is not called before maturity, the coupon might change or step up. To refresh definitions, a call is the right but not the obligation of an issuer to call a bond before maturity. With regard to commercial paper investments, Virginia Code states that only the highest quality issues may be used by Virginia public funds investors. Commercial paper has a maximum 270-day maturity. Commercial paper is issued by different corporations which have different credit quality and ratings. Investors need to pay close attention to the ratings for each issuer. S&P's highest rating for commercial paper is A, like alpha, 1, A1. Moody's highest is P, P like Papa, for P1. And Fitch is F, like Foxtrot, F1, or F1+. There is a broad secondary market with good liquidity available for secondary commercial paper issues. Regarding discount securities, as an example, commercial paper, U.S. Treasury bills, and agency discount notes. Agency discount notes usually have a maximum maturity of 1 year. These securities trade at a discounted dollar price. The accretion to maturity is the return on the investment and is expressed as a yield. Investors purchase a stated face amount, for example, $1 million. As an example, $1 million discounted for a 9-month maturity to roughly $991,562 matures in 9 months. The difference of $8,438 is approximately a 1.25% yield. These items, again, most often settle either cash for same day or next day. They, too, have a stated CUSIP, description, and maturity. Regarding transparency, many governments require competitive transactions to select and purchase investments. Some government investors use a bidding process, getting a specified minimum number of indications from previously approved vendors and choosing an investment from those. More and more investors, both governmental and private sector, are choosing electronic platforms for ease of use, documentation, and time and cost effectiveness. With regard to settlement and holding investments safely for public funds investors, most of the items we're discussing today are book entry, on the computer, if you will. They are not physical securities that you're having to store paper in a safe. The delivery versus payment method uses a third-party trustee or custodian as a safekeeping agent, acting on behalf of a governmental or public investor client. This agent, in cases of securities and trade settlement, does not release funds until the securities have been delivered. An important point is that there's no float and no other parties have control of the governmental funds. The investor always has either the securities or cash in its account. Another method to settle securities trades is a cash account, in which a broker-dealer might hold securities in the name of its customer. This, too, can often be a third party. Some people use their existing bank relationship and their securities clearing operation to act as third-party trustee. Something to keep in mind, going back to safety, is that these accounts are often insured by the Securities Investor Protection Corporation, which protects securities and cash in accounts up to $500,000. It's important that public funds investors specify procedures within their policy for tracking, for notices, trade confirmations, and other communication. Multibank Securities as a broker-dealer is based in Southfield, Michigan, and we've had a Florida office since 1995. We're a member of the Financial Industry Regulatory Authority since 1987, and as a broker-dealer, we are also members of the Securities Investor Protection Corporation. We are registered with the Municipal Securities Rulemaking Board. Our central registration depository number is 22098. Some people refer to that as a permanent record. Our business is concentrated in institutional fixed income, and we currently serve more than 5,000 accounts nationwide. We are an approved underwriter for debentures for the Federal National Mortgage Association, also known as Fannie Mae, the Federal Home Loan Mortgage Corporation, also known as Freddie Mac, the Federal Agricultural Mortgage Corporation, Farmer Mac, and the Federal Home Loan Bank System. We are significant underwriters of FDIC-insured and NCUA-insured certificates of deposit and share certificates. Multibank Securities is the exclusive provider of eConnect Direct, the online investment platform for governmental and institutional investors. We've been affiliated with the National Association of Counties since 2014, when they chose to endorse Multibank Securities and the eConnect Direct platform. The Virginia Association of Counties endorsed us in 2015, and shortly thereafter came on board as a client as well. Additionally, the National Association of County Collectors, Treasurers, and Finance Officers, NACTFO, has endorsed us since 2015. We are a certified veteran-owned business, and as previously discussed, we help to administer the Public Funds Investor Guide available to clients through the Multibank Securities Institute. We have hundreds of municipal clients nationwide and wanted to share with our audience today comments from 3 current Commonwealth of Virginia relationships regarding how they use eConnect Direct. Dean Lynch, the executive director at VACO, comments that they've used eConnect Direct to invest a portion of their funds for almost 2 years. He emphasizes that it simplifies their investment process and provides very easy access to the investment vehicles that meet their policies and helps them to maximize returns. Another Commonwealth County client mentions that eConnect Direct assists them in portfolio management, helps them to easily view their account activity, and access needed documents, including trade confirmations and statements, and helps them to see and buy FDIC-insured CDs safely. A Commonwealth Housing Authority client describes that the eConnect Direct platform regarding investments helps them to reduce worry, maintain their focus on their other responsibilities, with easy access being just a mouse click away. The interface is clear, user-friendly, and efficient, and of course cost-effective because there are no fees. The last part of this presentation, I want to again cover some of the resources, market information, and bibliography that was used in preparation of the presentation. Under Resources on slide 27, since as we've discussed, most items are going to be priced off of the benchmark U.S. Treasury yields, the Wall Street Journal Online provides a Treasury yield page. It's not live, but it updates frequently and can be a very good tool. Additionally, there's the U.S. Department of the Treasury webpage. The Securities Industry and Financial Markets Association is an excellent source of educational and reference material. Further information can be found as well on the Federal Reserve System webpage. Regarding news and market information, the FINRA market data page has information on treasuries and other securities. Real Clear Markets is a news aggregator which is updated usually twice a day in the morning and afternoon, has broad market-based information up to date. Business Insider is also a news aggregator that scrolls continuously and updates frequently. Zero Hedge is a contrarian take on markets, and as a news aggregator, updates constantly. Lastly, the bibliography for some of the material used in this presentation include the Investopedia.com dictionary, the Federal Reserve Bank of St. Louis, Missouri, FRED, which is an economic research and data webpage, SIFMA, Investing in Bonds, and of course, the applicable Virginia statutes. By way of disclaimer, to emphasize, Multibank Securities is a broker-dealer and not an investment advisor. We offer no regulatory nor audit advice. And as mentioned earlier, the firm's CRD number is 22098. I'm your presenter, Greg Pagans. In June of 2017, I'll complete my 31st year in the financial markets industry. I hold multiple licenses, including a Series 7 General Securities and Series 24 Principals license. We appreciate your time and attention today. Hope you found the presentation helpful and informative. Please contact your Multibank Securities representative for further information. Thank you and good day.